So you probably have learned about the alternative asset classes in conventional finance. So what do we mean by alternative asset classes? We mean those assets which are not under the classification of conventional asset classes, which include the equities, fixed income asset, and the cash. So usually we mean the equities, fixed income securities, and cash as conventional asset classes and traditional asset classes. But we look for some alternative asset classes to diversify our portfolio, to increase the performance of our portfolio. So those kind of assets in general we include or we term as alternative asset classes. So some common examples of alternative asset classes are investment in commodities, investment in real estate, then private equities, then another subclassification of private equities investment of venture capital, then hedge fund, investment in a hedge fund. So these are some examples of alternative asset classes. So in today's class, we'll try to look for some alternative asset classes which are or which can be made Sharia compliant, and we can make a Sharia compliant investment in those Sharia compliant alternative asset classes. So asset diversification or portfolio diversification is a desirable objective, but there are some inherent risk when we include some alternative asset classes in our portfolio. Like traditional asset classes, we often see that alternative asset classes price discovery is not very plain or very available. So there are some issues when we price the alternative asset classes. Say, for example, if we think of real estate in our country, so at this point, we do not have the secondary market for real estate, established real estate market secondary. So in that case, we have to rely on individual negotiations. So that is a challenge, but that challenge is not available when you look for traditional asset classes. And alternatively, if we think of private equity investment, say you have invested in a company which is not publicly traded. Say, for example, you have invested in a startup company, ABC, and now you want to sell off your holding in that privately held company, ABC. So you have to negotiate with interested parties. So price is not readily available. Price will depend on some degree of negotiation. So these are some challenges, and another challenge is alternative asset classes are usually more riskier than the conventional asset classes. And for what purposes alternative asset class investment is desirable? Because people often look for enhancing the return of their portfolio. So enhancement of return comes up with enhancement of risk in portfolio. So alternative asset classes are a good option for adding these assets in your portfolio. So conventional finance and banking institutions provide their clients investment facilities in alternative asset classes. At the same time, what Islamic finance and banking institutions can do, they can also to keep with the competition in the financial market, they can provide investment facility to their client to invest in alternative asset classes. So now, these are some contents we like to explore. First of all, we'll try to see what are the equity investment available in Islamic finance. You will see some equity investment common across conventional finance and also Islamic finance. And also you'll see private equity finance, then Musharaka structures for private equity finance, then venture capital. So you probably have come to learn about some of this in your conventional finance classes. So some equity-based financing are already familiar with us from our previous classes. So you probably can recall the Mudaraba from the class where we discussed about the deposit products in Islamic banks and Islamic financial institutions. And Musharaka, we didn't spend much time on learning Musharaka, but you probably have seen this term in the lecture when we discussed about the Islamic finance instrument. So these two types of financing are equity-based financing, or more specifically PLS-based financing, where investors share profit and loss together. But at the same time, debt-based financing is also available in Islamic finance, which are one example of debt-based financing is we already went through, that is Murabaha financing. So before going to discussion on private equity, let's have some review discussion, which will help us to know that why investment in private equity or private equity is essential. Why the traditional Mudaraba, traditional Musharaka, and Murabaha are not adequate for us. So Musharaka, this term comes from the word shirk, which is which means partnership. So if two or more people agree together that they will make a joint venture, they'll make a partnership, and they will share the profit and loss together at a determined ratio. In that case, their agreement is a kind of musharaka. So how the profit is shared? So the rule is that usually the profit can be shared based on the amount of capital invested by the participants or any agreed ratio on which all participants are satisfied. However, the loss is to be allocated based on the contribution of capital. The loss ratio is always based on the ratio of capital share. And there will not be any personal liability. It's kind of if there is a failure, individual investor will not be personally responsible to reimburse the loss or to compensate for the loss. So this is a basic structure of Musharaka, and we'll try to see example that how Musharaka financing can be used. Remember when we have mentioned that profit loss will be shared, that's why Musharaka is a kind of equity-based financing. So you see, it is comparable to sharing financing, equity or business partnership financing, joint venture financing. All these are covered under Musharaka. So one very simple example where two partners, two investors have agreed together that they will make a business and they'll make a venture, and they both will contribute to the business. One will contribute 10 million and another one will contribute 30 million. Total 40 million capital will be contributed. So you see that their capital contribution ratio is 25/75 or 1:3. So they have formed the business venture. So after operation of their business venture, the profit has been generated by the business venture and profit has been accumulated as 10 million. Now the question is how the profit will be distributed. And you see that profit here is distributed according to the share of the capital contribution, 25%, 75% or 1:3. So out of the 10 million profit, 2.5 million profit is accrued to the investor A and 7.5 million profit is accrued to the investor B. So this is a very typical structure of Musharaka or joint venture or equity partnership. So I'm very confident that you are familiar with some features of partnership agreement, and those features are commonly applicable in the Musharaka kind of agreement also. So let me show you another example where I have added loss, the loss scenario. So you see, when there is a loss, one thing we always need to maintain in Musharaka agreement, that loss must be shared in proportion to the contributed capital. The loss proportion ratio cannot be changed. Loss proportion ratio must be in proportionate of contributed capital. However, profit arrangement ratio can be changed. So why profit arrangement ratio can be changed? Because some partners might provide more financial capital. Some partners might provide more human resource capital. So their profit ratio may not be justified if these are determined solely based on the provided capital. So that's why the profit ratio can vary. Now we like to see an example of diminishing Musharaka, which is very much popular in real estate financing by the Islamic banks and financial institutions. So by diminishing Musharaka, we have to understand that obviously there will be a joint venture agreement where at least two parties will join together. So let me give you an example. Say, for example, you are Mr. X and you need a home, you like to buy a home or real estate, and that home is, say, for example, 100 million taka costing, and you have gone to conventional bank, and conventional bank has agreed with your proposal, and conventional bank has given you the 80 million taka loan and has mentioned that you will provide, I mean, you, Mr. X, will provide 20 million and I will provide 80 million. And over the time, you will make payment, installment payment to me. And when you have calculated the installment payment in total, you see that the payment is close to 120 million. The bank has financed 80 million, but you have to pay in installment in total 120 million. So this is a kind of service from the conventional bank. But when you go to Islamic bank, and Islamic bank is mentioning that Musharaka is available, you can take the Musharaka product from us to finance your home purchase. So what will be the structure in that case? So bank has mentioned that we both will jointly own this house, what you are planning to buy. So I will pay 80% of the price, and you will pay the 20% of the price. And now I have 80% ownership, and you have ownership of 20%. So customer has agreed with the bank. Now customer has shared his intention to the bank that I like to, you will not be living in the house, but I will be living in the house, or I will be living at this home. So in that case, what bank will do? Bank will lease out, or bank will rent out the house to the customer. Now the question is, bank will lease out 100% of the home or 80% of the home to the customer? Islamic bank?
100%, sir.
80%. Okay, because bank has the 80% ownership. So for 80% lease, bank will charge some rental payment from the customer, some rental payment from the customer. Say, for example, 10 years, bank is renting out the house to the customer. So say that 10,000 is rent per month. So customer has shared his intention to the bank that after 10 years, I want to see as the owner of the house. In that case, bank will say that, okay, in that case, you can purchase this house or purchase the ownership from me by paying an installment payment. By paying an installment payment, say 25,000 taka additional will be paid. 25,000 taka additional payment will be paid. Okay. So you see, this will be gradually go down. I mean, this payment will gradually come down over time. So customer will now pay a total payment which includes a portion which is compensating the rent, and another portion which will help him to own the house at the expiry of the contract. So over time, what will happen? Bank will lose its ownership at the house and customer will have more ownership at the house over time. Have you got it up to this? When this payment will continue, what will happen over time? Who will lose the ownership or estate? Bank?
Bank will lose the ownership.
Okay. So you say customer has made the payment for the piece of property, and at the end of the expiry or at the expiry, bank will transfer the ownership to the customer. You see that the ownership of the bank declines to 0 and ownership of the customer increase to 100% from 20% initial. Now the question is, what bank has done here? Bank has provided any cash financing, or bank has sold a house to the customer over time at installment basis? What bank has done, I mean, in a very summary point, though initially they both jointly purchased the house, but what happened finally? Bank has sold out his ownership to the customer, ownership of the house, or bank has provided any cash financing?
All the ownership.
Okay. So this is how the Islamic bank works. Now people want to compare it with the conventional bank, that if bank in conventional bank would provide, say, 80 million financing at a cost of 120 million repayment, conventional bank. And now if Islamic bank has sold its ownership of 80 million at 120 million, people want to ask, what is the difference? Have we got the question? If the price of the home at which bank will sell its 80% ownership to the customer is 120 million, and if the customer are taking finance from the conventional bank at 120 million repayment, what is the difference between these two?
Conventional bank take the whole power of attorney of the property.
Sorry?
Conventional bank take the whole power of attorney of the property with mortgage. Whereas there is partnership agreement with the customer, with Islamic bank.
Okay, so bank is taking ownership here, right? Bank is taking ownership here. But in conventional system, who is taking the ownership initially? Though the house will remain as collateral in the hand of bank, but ownership is in the hand of customer. I mean, when you will buy the house from the real estate company, who will be the customer there? Bank or only customer, or both in conventional financing?
The customer will be
The customer
will be the customer, and the bank will provide the money for interest. Or in this case of Musharaka, diminishing Musharaka,
both bank and customer will be the customer, right?
Yes, and from the real estate company,
Hmm.
bank will buy the customer.
Right. So here you see that over time, say bank and customer both are holding the ownership, right? Up to this payment. Okay. Up to this, they are actually still here. Bank is taking 10% on, sorry, bank is taking 9% and customer is taking 90% ownership. So you see the any kind of if any unforeseen emergencies happen in this period, who will bear the loss? Bank will bear 10%, customer will bear 90%. Will it happen?
Yes, sir.
But in this case, who will bear the loss? The owner?
Customer.
The customer. Okay. So apparently they may look same, but there are some inherent differences. Okay. Apparently they may look same, but there are differences. This is a kind of selling product, selling house. This one, where the Islamic bank is selling the home to the customer. I mean the ownership of the home precisely. But here the bank is selling money, and making money out of money is strictly prohibited in Islam. Okay. So whatever the mechanism you do, you have to come up with the business mechanism. You cannot come up with a mechanism where you have no participation in the venture, you have no participation in the agreement, you just giving out money and you just want to make money out of money. So Islam is not giving avenue to do this. Okay. So that's why you are trying to learn this alternative structure of making money by selling product. Okay. So let's summarize what we have learned from the diminishing Musharaka. Higher. Okay. Okay. This is not here. Okay. So now let me summarize some points by taking comments from you. How many agreements should be made in Musharaka? I mean, in particularly diminishing Musharaka, how many agreements between bank and customer? You see, the first agreement is ownership agreement. What is ownership agreement? Ownership agreement here is that both bank and customer will own the house which will be bought, at this home. Okay, 80%, 20%. This is one agreement. Number two agreement. Number two agreement is a lease agreement. You see who have given the lease to whom? Who has given the lease to whom?
Sir, bank দিচ্ছে customer কে।
Okay. So this is the another agreement is lease agreement. Okay. Can anyone tell me what happened to the third agreement? Is there any third agreement?
So it is a partnership agreement, sir.
Sale agreement, sir.
Exactly. The sale agreement. Sale agreement between bank and customer. Okay, so I believe that you have got the concept of diminishing Musharaka, and remember the features of the Musharaka, because we will be comparing this diminishing Musharaka or Musharaka simplistically with the private equity later. Okay. Now let me ask you what you can recall from the Mudaraba deposits. Mudaraba can also be a finance. Mudaraba, it was in the deposit lecture, but I mentioned Mudaraba investment deposits because you are working as an investor here. So can you recall that who are the two parties in Mudaraba? There are two parties. One party is Rabul Mal, who is the owner of wealth or who is owning the money. And another party is Mudarib. So Mudarib is the manager, Mudarib is the entrepreneur. Okay. So what happens in Mudaraba? Now, in Mudaraba, the manager or the entrepreneur works as a trustee. Trustee of whom? Trustee of Rabul Mal. Now it is the Mudarib's responsibility to take care of the wealth or money provided by Rabul Mal. And they also work together as partners, and they will decide that how much profit will be shared between them. So their profit will be pre-agreed. However, if there is any loss in the business, the financial burden will be borne by the Rabul Mal. The Mudarib will not take any financial burden. So what burden has Mudarib taken? Mudarib has taken the loss of his entrepreneurial skills, what he or she invested throughout the term. So he or she couldn't get the compensation for the skills or effort he or she provided during this term. So in this way, Mudaraba financing works. Now you probably can recall that we mentioned two types of Mudaraba investment deposits. One was unrestricted and another one is restricted. In case of unrestricted Mudaraba investment deposits, the Mudarib has more discretion. However, in case of restricted Mudaraba deposits, Rabul Mal specify where their money will be invested. So we talked about the differences in risk between these two types of Mudaraba investment deposits. So remember, I'm recalling the investment deposits, but try to understand that this is a kind of financing to the person or entity who will be using the money. So you see that investor and Mudarib, what Mudarib has invested, management or human resource capital, not the financial capital. So the profit cannot be fixed amount, but the profit and loss ratio can be prefixed at a pre-agreed ratio. Now the question is, the Musharaka and Mudaraba. Do you think they are more like equity-based financing or they are more like debt-based financing? Musharaka and Mudaraba, they are more like debt-based financing, or they are more like debt-based financing? The question to you.
Equity-based Musharaka.
Equity-based financing. Okay, good. Now, can you recall the Murabaha? Can you recall the Murabaha in the class Islamic Finance Instrument? I mistakenly pronounced Murabaha as Mudaraba. But can you recall the concept what we discussed? Murabaha type of financing.
Yes, sir. In Murabaha, bank purchase the product for
You
the
need a
customer.
car. You need a car. What will you do?
I go to Islamic Bank. They
Yeah.
purchase the car from me.
Right. And you know that the car
And
price
give
is,
it to
say,
me
for
and
example, $100,000. Bank will pay $100,000 to the car supplier or car seller, but bank will sell the same car to you at how much price? At
130,000.
130,000 at a markup price, right? So this payment was a spot payment, but you will make a
Deferred payment.
deferred payment, and this payment includes some profit or markup. Okay. Now you see, when bank is purchasing this for you, bank is taking ownership for itself, or bank is taking ownership for you?
For the customer.
If bank
Bank is the owner,
uses,
sir. First time the bank will be the owner.
right, if bank makes the customer owner, it will become a conventional finance. Bank cannot make the customer owner here. Have you got it?
Yes, sir.
So bank has to make the customer owner later. Initially, bank must own the asset before selling it. If bank purchases directly the car from the goods supplier or car supplier, and the document mentions that the owner is this customer, and bank has paid for it, and customer is paying to the bank, in that case, it is a kind of conventional finance. For Islamic finance, bank has to be owner. When bank is owner, then bank, what can bank do then? Bank can then sell. Can you sell anything without owning it? Can you sell anything without owning it?
No, sir, we cannot.
You cannot do conventionally, but you can do in finance, short selling. Have you heard about? You can sell the securities without owning it. Have you heard about the short selling?
Yes, sir.
Okay. So you will check that whether short selling is allowed in Islamic finance or not. Okay. Now the question to you. Does the Murabaha financing look like a debt-based financing? You see, over time, customer will make the installment payment to clear the dues of 130,000. Now, the question is, does Murabaha financing look like debt-based financing? If it does, why? Am I right this time? I am pronouncing Murabaha rightly, or I am pronouncing Mudaraba?
No, sir, it's okay. Murabaha.
Okay, I believe that the question is clear to you. I'm trying to claim that it is a debt-based financing. Now, the question is, for what feature it should be similar to debt-based financing? You see that bank has sold its ownership based on a deferred payment. Bank has sold out its ownership of the car based on a deferred payment. You will be
Yes, sir.
making payment over time. Okay. And bank is taking any share of loss, what may happen during this time? The sale agreement has already been done. Okay. Though the title will be transferred upon the clearance of whole payment title. But sale agreement that I am selling this car to you happens immediately after purchasing of the car. Okay, not after getting all the payment. After getting all the payment, the document will be transferred, but goods will be immediately transferred, or the ownership will be transferred later. But you see that you have already sold out when you have made the agreement. I mean, based on a deferred payment, based on a deferred payment. Based on deferred payment, I am selling this car to you. So bank is not here taking any share of loss with the customer. So it is a characteristic of debt provider that they will not bear any loss which may happen with the borrower. So it is not exactly like a conventional debt, but it has some characteristics which are similar to debt. Okay. Now let's compare Musharaka and the equity investment. Okay. Now Musharaka, the agreement what you have made together, which is more likely, it is a very it is for a very long term, unlimited term, or for a limited term. The Musharaka agreement, you're doing a joint venture. What do you think? Partnership agreement is for 100 years, 50 years, or 20 years, 5 years, which is very likely. If you do a Musharaka agreement, say three people have formed, three people jointly have formed the Pathao. Now, do you think their original partners are now in this agreement? They have made a new partnership over this time. The old partners are not continuing. One or two old partners are now continuing, but some partners have left. So what do you think? if you do a joint venture agreement, it is for a very long term or for a very short term or limited duration? Confusion? No response?
No confusion, sir.
No confusion. Okay. So it is for relatively shorter term. I mean, it is not applicable for a very long term. Okay. But you are very familiar with equity investment, right? So equity is a kind of financing which exists in perpetuity. Are you familiar with this term? Perpetuity?
Yes, sir.
Okay. Anyone unfamiliar with this term? Because some of you are from different background. Anyone? It will continue for foreseeable future. Okay. So if you have a very long-term perspective, you want to build a public limited company or a private limited company, will you be more interested to take a Musharaka financing or equity investment?
Equity investment.
Equity investment will be more suitable for you. Okay. Now you see that here the nature of ownership is a kind of partnership. And they are jointly owning. And here in equity investment, shareholders are owning the business with respect to their individual contribution to capital. And when you are in a Musharaka, say after 3 years between XYZ partnership, X wants to take a leave. He has to make the Y and Z agreed that I will be leaving and you have no problem with that. If YZ does not give the approval to X that you can leave, X cannot leave in its own decision, because there should be an agreement between among the existing partners. But if X dies all on a sudden, that is a separate issue. Okay. But if you are a shareholder, you can leave by selling your share anytime without asking any shareholder, any other existing shareholder. So which one is more liquid, Musharaka or equity investment? From an investor perspective, equity investment is more liquid. And in Musharaka, investor obtains profit share in terms of the preset profit ratio, profit allocation ratio. But in equity investment, it depends on the dividend payout. Okay. And when the business terminates, usually partners want to get their capital back. They are not more interested to see that they have invested 100 capital. They want to see that their capital is now 500 worth. Because it is a kind of Musharaka partnership joint venture agreement. It is, and you have taken much profit by this time, and it is very unlikely that there is accumulated profit and you can sell it at 500. It can be, but it is less likely. But in case of equity investment, shareholders take dividend that is not that much, which is available like a profit share in Musharaka. Shareholders are more interested to see that their shares are trading at a appreciated price. Say they purchase their share at 50 taka, now they can sell their share at a 5,000 taka. So they focus more on capital gain. I mean the equity investors. Now, we like to see that how equity investment is preferred over Mudaraba. You probably can recall the Mudaraba. In Mudaraba, the Rabal Mal, who is the financier, he has limited right. At the same time, and also limited liabilities. Limited liabilities to that extent that his or her personal property cannot be taken to pay off the liabilities of the business. In that case, it can be limited liability. And equity investment usually comes up with limited liability. And here, entrepreneur works as a trustee, but here manager works as a trustee for the shareholders, not the entrepreneur. Entrepreneur are also the shareholders. They can be sponsor shareholders. And these parties have different types of rights and liabilities. And you see that though financier participated in Mudaraba, sorry, not financier, I mean the Mudarib participated in the Mudaraba agreement, but all losses will be borne by Rabal Mal. So Rabal Mal is the financier who provides all financial capital. But in case of profit sharing, both Mudarib and the Rabal Mal will share profit. And now you see that in comparison to these two issues, in case of equity investment, managers can be fired at any point of time. They do not have any linkage with the ownership, except sometimes, not sometimes, nowadays the CEO is CEO and top management also holds the shares. In that case, they may retain position as shareholders, but their position as managers can be dismissed. This point has been mentioned here. Managers can have share options. And all shareholders can enjoy both capital gain and also incur capital loss. Now, when we are making equity investment, we will be provided with different types of shares, which are also available in conventional finance. And usually you will see this term in your reading FICA Academy, and FICA Academy approves which is acceptable in Sharia and which is not acceptable in Sharia. And in our country, there are global Sharia supervisory board, and they also approve which product is Sharia compliant, which product which Islamic banks can introduce, which products Islamic banks cannot introduce. So category of shareholding. So it can be ordinary share, it can be preference share, it can be convertible stocks, or it can be convertible preferred stock in comparison to conventional preferred stock, conventional convertible preferred stock. So as long as the business is doing the Sharia compliant business, there is no issue of owning that business, and you will have full voting right and there is no issue from the Sharia, it is acceptable. And the profit or dividend percentage can fluctuate over time, and you will be responsible for incurring loss of your capital. And how much loss the ordinary shareholder afford? Any idea? Will they be responsible from their personal belongings for the loss of business? What do you think?
Should be no.
Not. Okay. So they will be responsible up to the amount of capital they contributed. Okay. And I know very well that you are much familiar with this. Yeah, then preference share, where the dividend are fixed earlier when in the time of issuance, but they get priority when the business is liquidated. The priority over whom? Priority over the ordinary or common shareholders, and they do not have the voting right. And there are debates that whether preference share is Sharia compliant or not Sharia compliant. So there are debate, and some have mentioned that these are acceptable, some have mentioned that these are not acceptable. And in case of convertible stock, it has all features of preference share, but what can be done that preference stock, it can be reverted to the ordinary common share after holding it for a number of periods. And what will be the conversion value? Conversion value will be determined based on the market condition. Can you recall that we mentioned about the Beximco Green Sukuk convertible? Sukuk will be convertible to which security? Beximco Green Sukuk, is this now will be convertible to which security? Have I mentioned it in last class?
Yes, sir. You have mentioned.
It will be convertible to Beximco common shares traded in the stock exchanges. Now, at which price? We do not know the price, because they have mentioned that it will be based on the average of last n number of days. I cannot recall the n number of days trading price, and they will take the average, and on that price they will make a discount, say 20% discount. You do not know what is okay. It is certain that 10 trading days price, but you do not know
They say
after
25% discount of 20 trading days.
Right.
Prior to
So,
record date for conversion.
Right. You see that number of trading days is 20. Now, after the end of the period or any point of time, now you see the number of trading days is certain 20, but you do not know at which price the Beximco share will be traded at these 20 working days. So this is becoming uncertain. I mean, though we are giving example of Sukuk, just try to understand that what kind of risk or uncertainty may arise in case of convertible stock. Okay. So Sukuk is a kind of convertible security in case of Beximco convertible Sukuk, not all Sukuk. Okay, not all Sukuk are convertible. But you see, have you seen that how the uncertainties have been invited? because you do not know what is going to happen in the 20 working days, right? Okay. So in that case, there is a element of gaharar. There is a element of uncertainty. Okay. So there will be 25% discount. Okay, 25% is a certain percentage, but you do not know what will be the value. Okay. This is uncertain. You do not know what is going to happen. So that's why inviting uncertainties at the based on this in agreement has been discouraged. Okay. So this should be determined earlier. Okay. Now, what shareholders receive for making equity investment? You're very familiar with this: cash dividend, stock dividend, right issues, shareholder perks. So a stock dividend has been renamed as scrip dividend here. And it can be in cash value or it can be at below market price. And you do not have any confusion with cash dividend. And right share is given to the existing shareholders. This is the first condition. Existing shareholder. Say, for example, if you are, if you have one share, you will get 0.5 new share. So for having 10 shares, you will get 5 new shares at below market price or at a right price. Okay. So this is also acceptable. It increases the number of shares, and in right share, the share capitalization or the share capital increases. In steep dividend, no changes in share capital. No changes in share capital. And apart from this kind of remuneration to the shareholders, what can you do? You can provide shareholders with some in-kind reward. So what are in-kind rewards? So in-kind rewards means, say, for example, you will see that some shareholders of company are using the car, using the smartphone, using the goods provided by the company. So these are some in-kind. So say US Bangla Airlines can provide their shareholders with some free air miles. So these are some examples of shareholder perks, which are kind of remuneration. Now, private equity finance. So what we just have seen, the advantage of equity financing over traditional Musharaka, Mudaraba kind of partnership financing. And now in case of private equity financing, what we are doing, we are investing in a company which is privately held. It is one way. Another way is we are taking a public limited company or public company to a private by making investment. Have you heard that some companies have delisted themselves from the company? From the stock exchange? Not by the regulator, themselves. Okay, so it is possible to go company from private to public. At the same time, it is also possible to convert the public company to the private. Okay. So private equity financing is investing in equity of a privately held company. That means their ownership are not publicly traded. Their ownership is not publicly traded. Or you can make investment for converting a public company to a privately held company. So it is not a very easy task. The latter one, converting a public company to a privately limited private limited company. In that case, you have to finance a big amount. Okay. Now, for which companies private equity finance is essential or necessary? So for large companies, say GSK and then Uber, at this point of time, they do not need any private equity finance because they have become so big that it will be difficult for the private equity financier to finance them. So usually the target of private equity financier is to finance some small, medium type of companies. So what they do, they provide some medium to long-term finance, and they provide share capital. They do not provide. I'm not saying that they provide the private. They do not provide the kind of debt financing. Okay. So out of the different categories of private equity financing, one category is venture capital. We'll mention more about it. Venture capital. So venture capital is a kind of private equity financing, which is basically target the company in a formative stage, angel stage or seed stage. The idea is in the mind of some people. It needs to be converted to some business plan, and the prototype of product has been created. The product has to be marketed. It's to be marketable. The facility should be created. In that case, venture capital is provided by the venture capital finance providers, or broadly private equity finance providers. So usually their target, private equity financing, their target is to fund the startup business and expand the existing business, and also to buy some established business also to spread risk. Established business does not mean that it should be a very big business, because it may not be possible. And if the company is in a distressed company, say for example, right now, what should I say? A company, let me give you an example of distressed company. You probably have heard about the Western Marine Shipyard. Have you heard about it?
Yes, sir.
Have you heard about Western Marine Shipyard company? This company was a very successful company 2 years back, but for last 2 years, this company has been struggling for shortage of demand due to pandemic, and also some existing constraints in their business. So private equity financier, what they can do, they can, this Western Marine Shipyard is right now publicly traded. So what can they do? They can purchase, they can take this company to private by converting from public to private, and they can make a turnaround. This was one of the very successful ship exporting companies in our country, but for some reason it cannot continue its good business nowadays. Okay, so these are some common purposes. Now let me ask you, what do you understand by startup? People often misuse the term startup. Let me ask you what you understand by startup. If I open a shop to sell notebook, PC, then smartphone, will it be a startup? If I open an e-commerce shop, very quick, we will be running out of time.
No, sir.
Okay, so in that case, what is a startup? What is not a startup? Okay, many of you will be interested to open a startup in your career at any point of time. Say, for example, eValley is a kind of a startup they are claiming. And Patho was a startup. Patho has been a startup. So these are some examples of startup companies. Say another very well recognized startup is Chaldal. So why they are a startup? Why at the same time, say, for example, what should I say? Then why they are not a startup? Why they are a startup?
The kind of business is first, like eValley and Pathav and Chaldan. This is a type of business which is introduced in this country.
Okay.
New idea generation.
Okay, new idea generation. New idea for what? So obviously new idea. Okay,
Unique
but
business maybe.
unique business. Okay, so let me make it very precise. So I got your answer. It should be unique something, right? It should be innovative something. Okay. Now for doing a business, first of all, you have to find out a problem. Then you have to find out a solution. Then you can claim that you have a business. And now this solution should be innovative. And now the question is this problem an existing problem or a new problem? This problem can be an existing problem. This problem can be a new problem. You can solve an existing problem with a solution, with an innovative solution. So Chaldal is doing nothing. Chaldal is selling groceries, but in an innovative way. That's why they have branded them as a startup, and they have received funding from the private equity capital providers, and they have also received seed funding. They received, okay. They are now a very mature one. They are no longer in a very angel stage, or they are no longer in a formative stage. So there are different stages. Okay, so venture capital is more linked with stages of business, or stages of enterprise. So usually when the company business, the company success has not been seen, and the company business is yet to be established, or company business is yet to be successful, it is still in a formative stage, or angel stage, or seed stage. In that case, venture capital is provided. When the company is in a stage which will be taken to IPO, in that case, the mezzanine financing is provided, or the mezzanine stage is called. So this is a kind of last stage before the company is going for IPO. So what do you think? When the company goes to IPO, in a very matured stage, the company has a now established business. In that case, the company goes to IPO. So IPO,
business.
yeah, the company has proved themselves that this company has established business. This company has good prospect. You have to prove yourself among the public, right? But when you are taking the private equity financing, do you have to prove? You have to prove, but you should not prove in that extent, which is essential when you are going for IPO financing. Okay, which one is more difficult, IPO financing or private equity financing? Which one is more difficult?
Sir, IPO financing, sir.
Okay, okay. So you got the reason why they are difficult. Okay. Now, do you think that we have venture capitalists or private equity financiers in our country? Do you know? Any idea? Any idea? Yes, no? We have private equity firms who provide private equities to small, medium companies, and we have venture capitalists in our country. Any idea? Yes, no?
No, sir.
No. Okay. The good news is that we have. Okay. So we have Venture Capital and Private Equity Association of Bangladesh, which comprises 8 entities who provide the venture capital, who provide the private equity. Okay. So what I will encourage you to explore, to go to their site, Venture Capital and Private Equity Association of Bangladesh, and you will see that what are their success stories, to which businesses they provided their venture capital, which businesses they provided their private equity. Okay. So let's move. Now, private equity has some certain advantages over senior debt. First of all, when you are taking private equity, usually the private equity providers have entered into your business with an intention of making a good amount of return. Don't forget the purpose. Don't forget the purpose. Here are the purposes. Okay. So you see, first of all, it takes a long time to get the success of a startup. So success of a startup, are you familiar with the success rate of a startup? I mean, out of hundreds a startup, how many startup can prove themselves as successful out of 100? Do you have any idea? Percentages? A startup has become a buzzword, and people come up with a statement that I am beginning a startup. He's beginning a startup, but we often keep ourselves busy with successful startup. But any idea regarding the statistics, how much percentage of the startups have proved themselves as successful? It is kind of 80%, 70, 60, 50.
I think 10 to 20%.
Okay, it is discouraging 5% or less than 5%. Okay, so you are close to the real actual rate. So the thing is that many entrepreneurs prove them or discovered them later that they are overconfident. Okay, so private equity financiers have to filter out the confident startup entrepreneur and the overconfident startup entrepreneur. Now, it takes long time to make the startup successful. So what you can get the private equity for longer term, but if you take the debt, in that case, you will not get a long-term financing. It will be maximum medium term, okay, or maximum, not the long-term debt is available, but not that amount, not that extent which is available in private equity. And private equity providers have two type of partners. Private equity funds have two type of partners. So one is GP, another one is LP, general partners and limited partners. So who are the general partners? General partners are those partners who, in addition to have their stake in the private equity, they also provide their managerial skills to turn around a company, to analyze a company, to explore, to really engage themselves with the business. But limited partners only provide their capital to the private equity finance company, finance entity, and they do not engage themselves in actual engagement. Okay. So you see, they are committed. Who? Private equity providers. So these are two type of categories of partners in a private equity firm. What I am mentioning here from the perspective of say startup entrepreneur, he would find the private equity financier more committed to his business until exit. But in case of senior debt, which is available from the conventional bank, when they will see that their money will be under threat, immediately the loan will be you will get notice that you need to repay your loan, this kind of, okay. So private equity provides solid, flexible capital base, which will help you for future growth and development. And you will have an adequate amount of cash flow later for repaying to the private equity capital providers. And they actually are engaged with you as a true partners, and they take risk for you, and they also work for bringing reward for your business. So in many extent, the private equity is more advantageous for entrepreneurs over taking senior debt. So we gave an example of diminishing Musharaka. This is the summary what we learned in the diminishing Musharaka. You can review it from here also. And this is how the ownership of bank declines and the ownership of client increases. And now Musharaka has some advantages. I mean, not Musharaka has advantages. What private equity can do, private equity providers can make a Musharaka agreement. Private equity providers can make a Musharaka agreement. Can you recall the Musharaka agreement? If they make a Musharaka agreement, what private equity providers will do? Private equity providers will invite some other partners. Okay, so the partners can be like the entrepreneur. Partners can be other private equity firms. Partners can be other Islamic banks. Partners can be other entities. Okay, so we'll see that which partners cannot be included in Musharaka agreement. So why Musharaka is good when you are in private equity firm? So you see that for private equity companies, there is no public valuation. It is the advantage of private equity, and you have less regulatory requirement. You do not have to disclose that how you have to disclose, but not that extent what is available or what is applicable for a public firm or public finance company. So private equity providers are actually in a small entity, or they can be a small entity in a sense that in comparison to public company. So private equity firms have a good amount of resources with them to make investment. So there are a good number of private equity companies which are privately held in developed countries and also in Islam, the Muslim countries. So when you are doing Musharaka, who are you? You are private equity firm. When you are doing a Musharaka agreement with others and you have your partners, and it is very likely that they will make they will breach the agreement, and it is the risk of breaching the agreement goes down when you are making a Musharaka agreement. But there are some transaction costs involved when you are doing a Musharaka agreement. And when you are doing Musharaka, what can you do? You can make a separate SPV. Why you are making SPV? You are making SPV because the assets of private equity firms will be under the SPV, and if there is any consequences on any unforeseen consequences on the investment, the private equity partners will not make their personal asset in a risk or not put their personal asset in a risk. SPV will incur the risk, and you're transferring risk of loss to the SPV. You are the private equity providers, don't forget it. Okay. Now the question is, when you are forming a Musharaka with some other partners, you may invite some other financiers. The question is, can you take borrowing? You have included partners. You are private equity, and you have included some partners. Now, can you also take loan? Now the answer is the venture for which you are making the Musharaka agreement, for which it cannot take loan. It cannot take loan. And why it is discouraged? Because when you are taking loan, in the name of the venture in which you are making investment, you are inviting additional risk for other partners, because the creditor who has provided this loan, he or she will have superior claim on the venture's asset over the claim of other Musharaka partners. Now, Musharaka can involve conventional bank. The answer is yes. A Musharaka can include conventional banks as partner. Do we have any problem if we include conventional bank as a Musharaka partner? What do you think? Have you got the question? Are you there with me?
Sir, not clear about the question.
Okay, are you clear with Musharaka? Musharaka has several partners.
Yes, sir.
Okay. Now, say for example, Musharaka, one partner is private equity firm, okay, who provided private equity. Can another partner in Musharaka be a conventional bank? The answer is yes.
No.
A conventional bank can be taken.
But they have to follow the Musharaka terms and conditions.
They have to follow the Musharaka terms and condition. Okay. So the answer is yes. And now the question is there any problem if Musharaka agreement includes any conventional bank?
The earnings of the conventional bank is not halal. That is the big.
Okay,
issue.
but here you are not relying on the earnings of the I mean
the investment they make that came from a haram source.
right. Okay, their source can be haram, but can they do business with you?
I think they can.
Yes, you're correct. They can. So in Musharaka agreement, you can also include the companies who have the debt. Now, when you are including companies who have the debt, what you need to do? You need to check the issues what we discussed in the screening of investment in probably lecture 4.
The screening criteria.
Yeah. So can you recall that their debt ratio cannot be greater than this percentage of capital?
33%.
Right. So you see the same. The value of the company's asset should be at least twice the value of its debts. But these are not same. When you are taking your partner who is in a debt, but these conditions are different, you see that at least if their debt is 1, their asset value should be at least 2. In that case, out of the total capital, what is their debt? 33%. If 1 taka is debt, okay. Here company's asset, not company equity. Okay. Company asset, out of the company asset, the debt can be, the asset should be at least twice. Okay. If the debt is 1, asset should be at least 2. The asset should be at least twice of the debt. And the company must be involved in halal activities. So it is for the condition for company. But I have question. How a riba-based conventional bank can be included in Musharaka who have been involved in haram activities? Is it a question? If the company which is included in the Musharaka should be in halal activities, can the conventional bank be included? Okay. So we'll explore more about it. Now let's wrap up our class with venture capital. We already talked about it. And venture capital is exclusively for this, most especially for this kind of company, for who are in the earliest stage and they need the business support. And target companies are this. They should have an exceptional management team. Their individuals' track record is very good, and their business has the opportunity to have a large market share. They have a patent of technology, new or possible, and they have a very attractive business proposition. So this is the typical business stage, and this is the stage at which the company decides to go to IPO. Usually at this stage, at the very after maturity or at maturity. And Musharaka venture capital is usually provided during this stage, business startup, rapid expansion. So usually you will find these stages are known as formative stage, angel stage, seed stage, and this is known as mezzanine stage, this way. So Musharaka financing has certain advantages, and risk and returns are shared together. However, there are some costs associated with it, and in Muslim countries, it is getting much acceptances because Musharaka is helping the business. Musharaka is helping the business to grow, and private equities are also using the Musharaka agreement to help the small and medium businesses to grow. And these things are happening. And out of the alternative asset classes, apart from the private equity, what we discussed, we need to understand the hedge fund, and we need to have a look on the real estate. So real estate is commonly held by the people in the Muslim countries, and it can be privately held, and it can also be publicly held. And there is a security, you probably have come to know that REIT security, real estate investment trust. So it is a kind of investment vehicle, a pool of real estate properties are purchased. A pool of real estate properties are purchased by taking finance from the REIT investors by issuing REIT securities. So REIT securities has been issued by SPB, say SPB, or it can be investment bank in conventional finance. And by taking money, this money are invested in real estate businesses or real estate properties. Now the question is this real estate privately held or real estate investment trust is Sharia compliant or not? Question to you. It is another mode of alternative asset class. It's very common real estate investment. What are the issues that may arise for Sharia non-compliance of real estate investment? Have you got the question? For what reason the real estate investment trust or privately held real estate investment may become Sharia incompliant? Have you got the question? By this time, you need to have a very basic idea that you probably can recall that we talked about some issues like this in screening of companies. Just try to relate. You are investing in a real estate. For what reason this investment in real estate will become Sharia incompliant? It's not all about that earning riba is haram or selling giving a bar is a haram. It's not all about, okay? Can you hear me?
Is it for uncertainty, sir?
Sorry?
Is it for uncertainty?
Uncertainties are there, but
Or about ownership, if the real estate company,
how?
if the investor or the Islamic bank does not have the ownership of the property, directly the ownership goes to the customer, that might be Sharia incompliant.
That can be, but usually it is not like that, because the SPB will actually procure the real estate properties in the name of SPB using the money of REIT investors. Okay, so the issues sometimes arise. For example, SPB has to receive how SPB will provide income to the REIT investors. SPB will provide income to the REIT investors by one form of income is rental income. Okay. Now, if SPB rents the real estate to a riba-based bank,
Or to something like bar or some.
so this is one example. Okay, or to some say cinema. So this is how real estate investment trust can become Sharia incompliant. Okay. Now, if I just ask you the last question, between you probably know very well hedge fund. hedge fund and private equity. So you know that hedge fund uses sophisticated strategies to make investment, and make money out of their investment. They use a sophisticated quantitative and technical strategies to make money. So the question is, between private equity and hedge fund, which one seems more Sharia compliant?
Private equity, as the risk is lower.
Risk is lower or uncertainty is lower? Who embraces more uncertainty? Private equity or hedge fund?
Hedge fund.
Hedge fund embraces more uncertainty. So I'll invite you to explore more about these issues, and you will be tested on this, what I just have showed some ways to explore or some things to explore. So that's all about for today. It was a great session, and